So our expectations for the dollar is for more strength. It really all will depend on the policy mix that's delivered out of the US, especially over the next few months. And the way we approach the question is to not really take a strong view on what exactly will be delivered in terms of tariffs and fiscal policy, but to try and assess what the market is pricing in terms of that policy mix. And when we do that exercise, we conclude that the market is not really pricing in very much, both in terms of tariffs or indeed the net fiscal impulse. So we think a fairer value for the dollar would be one closer to parity against the euro, for example. And there we would assess the intensity of the so-called Trump policy mix to be around 5 out of 10. And we see the market currently priced for something around 3 out of 10. So really a very modest delivery versus some of the things the US administration has been talking about.
George, very interesting how you already gave us your call for perhaps parity in the euro-US dollar trade. At the moment, we have euro at 1.05. But what I would like to understand here is whether there's perhaps more pressures coming for the euro beyond what Donald Trump is telling us. Because if we take into consideration what we heard of the last 24 hours out of France, with Michel Barnier warning a fiscal calamity there, what is the outlook here for the euro?
So I think fiscal policy, as it is for the US, is very relevant for Europe. And here we see two competing stories. The market has been focused on German fiscal policy because we have this early election in February. Potentially, if a new coalition can bypass or amend the debt brake, you may have supportive fiscal policy on that front. But then on the flip side, now we have these challenges out of France. So fiscal policy in France is tightening, fiscal policies in Italy is tightening. And I think it's going to be very difficult on balance for 2025 to see any sort of large convergence, so to speak, in terms of that policy stance. So we do see a very big difference between Europe and the US on this front, which should ultimately translate into wider rate spreads and potentially some risk premium on the euro relating to financial stability concerns. So in terms of our ECB expectations, it is certainly more dovish than, for example, some of the commentary that came out of ECB speakers this morning.
Yeah, actually, I was going to ask you about that, because the comments from Isabel Schnabel today are quite interesting and to some extent a little bit surprising, saying that there's limited room for rate cuts. How are you reading the comments, and do you think there's room here that you might have to adjust your expectations for ECB cuts as a result?
So I would be very cautious in taking for granted and taking a strong view on forward-looking comments that are coming out of any central bank speaker, whether that's the Fed or the ECB. Indeed, if you think about the Fed, just a few months ago, they were cutting about they cut by 50 basis points. They were talking about moving rates to neutral, which they were implying was around 3 to 3.5. But the reality is the forward-looking visibility on the macro is extremely low. I think this discussion around neutral rates is counterproductive because no one is able to accurately estimate this very extremely vague metric, which is also a moving target given the huge shifts in fiscal policy. So I would just take with a grain of salt a lot of the commentary that's coming out of central banks at this stage, including the ECB, and ultimately the outcome will be determined by the data. From our perspective, when we look at the data, it's pointing to the need for much larger ECB cuts.